Welcome back guys to another Zero DTE video, and today Ernie's going to be talking about the 1% rule, so make sure you stay tuned. If you're interested in becoming a pro trader, check out the link in the description where you can find Ernie's education platform. Enjoy guys.
I'm going to restate what Bruce is asking. He's trying to figure out his max position size. And the way I come out with that is a general rule that I'm a 50-50 trader. All right. So there's two things. I want to figure out max position size, and I'm a 50-50 trader. I have a standard that there's a drawdown that I never want to go below. And for most traders, that's 10%. So I've got these factors: 50-50 trader, 10% drawdown maximum. All right. How can we figure out what our max position size should be? One thing is that you could recognize what's the worst case scenario. Worst case scenario is that I could have a string of losers, or a string of best case scenarios that I could have a string of winners. That string of winners or losers ends up, from a statistical point of view, being about the same thing if I'm a 50-50 trader. There is a statistical measure or calculation that you can use that will approximate what that potential or likely maximum string of winners or losers is, and that's by taking the base 2 of the number of trades over that period, right? So that would mean that you'd go base 2 log of the number of trades. David's saying that my number of trades is what? I don't know how many trades, but let's say that it's 400. Comes out to 8.64. Pretty close to what Bruce said, 8. So you could take your max drawdown, and if you know that you're going to have, say, 9 losers in a row, I just round it up to 10. Makes the calculation a lot easier. 10 losers in a row, because I've had 12 losers in a row too. So obviously this calculation isn't perfect. It's just an estimate. Let's say 10 losers in a row. Worst case scenario is I have 10 losers in a row at my max position size. I'll just divide that into that 10% drawdown. That'll give me 1%. In other words, my max position size should never exceed 1%. That's how I come to that calculation. Now that works for trade accounts, $25,000 to $100,000, which is what most people are trading. I would even argue it probably goes up to $250,000. I never personally don't choose 10% as my max. I choose around 6% as my max because I'm way more conservative. And so if I choose my max position size from there, I very rarely trade my max position size. I allow that to be my maximum size in any trading session that I would commit. So I usually start off with a third to a half of my max position size, and then maybe put on another trade at a different time or add to that trade up to my max position size. That's what I do. And depending on the amount of volatility in the market, I will choose how much I will either constrain or expand my position size within that max position size. So when there's low volatility, I tend to contract a lot more and tend not to add to them and start smaller and fewer trades. When there's more volatility, I do the opposite. I expand and take on more risk, or take on more size. I don't know that it's more risk. I guess by numbers, it's more risk. I actually feel like when I'm with higher volatility, to me, it feels safer. Even though I'm trading bigger, I feel like I have far greater potential for capital efficiency and making more money. The rule of thumb is it comes out to about 1% of your total capital. Let's say between 0.5% and 1%. So you choose on which end of that spectrum that you want to trade. When you start getting to much smaller accounts, if you get down to a $5,000 account, just because of the ratio between the cost of a trade and the amount of money that you have, you can go to a much bigger percentage as a position size relative to your account. When you go to a much bigger account, it's actually the opposite way. You start going to a smaller overall percentage size relative to your account. But let's say that between, say, 25,000 and, I don't know, 150,000, that 1% rule is pretty good. It's a pretty good approximation. And that's what's worked well with me. And of course, contracting and expanding in volatility is another one of my strategies. So not only do I contract and expand based on width, but I also contract and expand based on my total capital allocation. That's why I'm really hoping for more volatility, because I want to spend money, because I know that percent profitable is probably going to rise if volatility rises. My capital efficiency will go up. Everything will go up.
Thanks for watching guys, I hope you enjoyed the video, and if you did, make sure you hit that subscribe button and hit the like button below. If there's any questions that you might have for Coach Ernie, make sure you leave them in the comment section. Thanks guys.